Hey everyone, welcome back to Corporate Decoder, the place where we strip away the corporate jargon to find the real story behind the money. Today we're diving into HEICO Corporation's latest quarterly report, and let me tell you, they've been busy buying up companies and making deals. Stick around to see how all this is playing out on their balance sheet and income statement. Also, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below if you want to join the conversation and get more exclusive content. This is HEICO Corporation's quarterly report, specifically covering the period up to July 31, 2000 and financial checkup for the company. What's really interesting is how much they've grown, especially through acquisitions. Let's start with the balance sheet. This is like a snapshot of what HEICO owns and what it owes at a specific moment. As of July 31, 2025, their total assets have grown to a massive $8.5 billion. That's a big jump from about $7.6 have grown to a massive $8.5 billion company's physical assets and identifiable intangible assets are worth. Now look at their accounts receivable, the money customers owe them. It's up to $598 million from $538 million. This makes sense as their sales have also increased. And their inventories have jumped too, from nearly $1.2 billion to over $1.3 billion. More sales generally mean needing more stuff to sell, but it's definitely a significant amount tied up here. As we saw, their goodwill has ballooned to $3.6 billion. This tells us that acquisitions are a massive part of their strategy. They're buying companies and likely expecting to make them even more profitable. On the debt side, their long-term debt is around $2.4 billion. This isn't totally out of line for a company of this size, especially with all the acquisitions, but it's something to keep an eye on. Now for the really interesting part for investors, shareholders' equity. This is what's theoretically left for the owners after all debts are paid. It's grown from about $3.7 billion to over $4.2 billion, a healthy increase, showing that the company is growing its book value. Let's move to the income statement, which shows how much money they made and spent over a period. For the 9 months ending July 31, 2025, HEICO reported net sales of over 325, ICGAR reported net sales of over 325, HEICO reported net sales of over $3.2 billion for the same period last year. That's a solid 15% increase in sales, and their operating income, which is profit from their core business before interest and taxes, also saw healthy growth. It jumped from $650 million this year, an increase of over 22%. This shows they are not just selling more, but also becoming more efficient. The bottom line, net income attributable to HEICO shareholders surged by 34% to $520 for the first 9 months. This translates to earnings per share of $3.57, up from 2.67 cents, up from 2.67 fans last year. That's some serious profit growth. Looking closer at the 3-month period ending July 31, 2025, net sales were $1.15 billion, an increase of 16% compared to the same period last year. This momentum is clearly carrying through the quarters. Selling, general and administrative expenses, or SG&A, went up, which is to be expected with increased sales and acquisitions. They spent about $560 million last year, but importantly, as a percentage of sales, these costs actually went down slightly, which is a sign of good cost management. They are becoming more efficient as they grow. The statement of comprehensive income shows us income from operations plus other items that affect equity but aren't part of the regular income statement. HEICO's comprehensive income also grew nicely, showing a gain of $585 million last year. The statement of shareholders' equity details changes in equity accounts. It highlights things like dividend payments and stock issuances. For example, they paid cash dividends of $32 million for the 9 months ended July 31, 2025. This section shows how their equity components shifted. Notice the significant increase in capital in excess of par value, which comes from issuing new shares, often related to acquisitions or stock options. It's interesting to see amounts like HEICO stock held by a revocable trust always staying the same, suggesting a static arrangement that isn't actively changing. Now let's talk cash flow. This tells us where the cash is coming from and going. For the first 9 months of 2025, HEICO generated a very strong $639 million the same period last year. Increased and creased $7 million increase from operations. This is a significant increase from $46.7 million in the same period last year. This is a significant increase from $406.7 million increase from $46.7 million. Where did a lot of their cash go? Investing activities. They spent a whopping $630 million on acquisitions, net of cash acquired. This reinforces that buying other companies is their primary growth engine. On the financing side, they borrowed $495 million on their credit facility and repaid $275 million. This suggests they are actively using debt to fund their growth and operations. This section details their acquisitions in 2025. They acquired SVM Private Limited, Honeywell's avionics product lines, Millennium International, Rosen Aviation, and Gables Engineering. These are all in the aerospace and defense technology sectors, which align perfectly with HEICO's core business described as the Flight Support Group and Electronic Technologies Group. The total consideration for these 2025 acquisitions was over $651 million in cash and stock. And as we saw on the balance sheet, these acquisitions resulted in over $252 million being added to their goodwill. This means they paid a premium for these companies, believing they can extract more value from them. This part breaks down the intangible assets like customer relationships and intellectual property. These are the non-physical assets that add value to a company. The growth in these figures from $1.3 billion to over $1.5 billion in net value also reflects the impact of their acquisitions. Amortization expense for these intangibles was around $101 million for the 9 months. A significant cost, but a necessary one for acquired intellectual property. Here's a look at their long-term debt. They have about one-turn debt. They have about $1.2 billion in senior unsecured notes, not including their revolving credit facility borrowings. Their total debt is around $2.4 billion. The interest rates on their notes are about 5.5%, which is a reasonable cost of borrowing in today's market. Their total consolidated assets for the Flight Support Group were $4.6 billion, while the Electronic Technologies Group held $3.4 billion. This clearly shows the Flight Support Group is the larger segment of the two. This section breaks down performance by their two main business segments, the Flight Support Group, or FSG, and the Electronic Technologies Group, or ETG. FSG is their largest segment, making up about 2/3 of their net sales. ETG is growing nicely too. They report sales by product line and by industry served. FSG, which deals with things like replacement parts for aircraft and repair services, saw its sales jump to $228 billion for the 9 months. This growth was driven by strong demand across the board, including aftermarket parts, repair and overhaul, and specialty products. ETG, focused on electronic components for defense, aerospace and other industries, also showed good growth, with sales reaching $1.03 billion for the 9 months. Their key markets here are defense, space and general aerospace. Both segments are profitable. FSG brought in $549 million in operating income, while ETG contributed $235 million. These figures are before corporate expenses. The corporate segment itself had an operating loss of about $45 million, which is normal for a company that centralizes some costs. This is where we see the impact of all this on shareholder value. Diluted earnings per share for the 9 months were $3.27, a significant increase from $2.67 last year. That's about a 34% jump, very strong performance. Looking ahead, HEICO is optimistic about continued sales growth, both from core business and new acquisitions. They are focused on a strategy of acquiring companies and growing organically. They generate a lot of cash, $639 million in the first 9 months, and they expect to spend between $65 and $70 million on capital expenditures this year. They feel confident that their cash flow access to credit will cover their needs for at least the next year. Now, for my take on HEICO, they're a company that is executing its strategy very effectively. Their acquisitions are integrated smoothly, driving sales and profit growth. The increase in goodwill shows they are willing to pay for strategic acquisitions, and the resulting higher earnings per share suggests they are making smart choices. A key strength is their dual segment approach, FSG and ETG, covering critical aerospace and defense markets that have strong, sustained demand. Their ability to grow both organically and through acquisitions while also managing expenses well is highly impressive. The fact that their SG&A expenses as a percentage of sales are decreasing even as they grow is a testament to their operational efficiency. The main risk, as always with aggressive acquirers, is overpaying for companies or failing to integrate them effectively. The significant goodwill on their balance sheet means that if any of these acquired businesses underperform, HEICO could face substantial write-downs. However, their consistent growth and profitability suggest they are managing this risk well for now. In short, HEICO is a very well-run company that knows how to grow through acquisition and keep its operations profitable. Alright, that's our breakdown of HEICO's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.